I want to break down how the carry trade works in a way that actually makes sense for you, because if you don't understand this part, you're going to miss the entire setup. Now, let me go back to something I said before, which is for 30 years, that's a long time, Japan had near zero interest rates, which means borrowing yen was basically free. And global institutions, banks, hedge funds, institutions said, hold on, if we can borrow money from Japan for almost nothing and then invest that money somewhere else with much higher returns, that's free profit. So here's exactly what they did. Number one, they borrowed cheap yen at, again, 0% interest. Number two, they convert that yen into dollars. So now they're holding US cash. And then number three, they use that cash to buy higher yielding assets. Like, as I said, bonds, stocks, tech, emerging markets, crypto, all of that. This was the carry trade. Borrowing at almost nothing, invest 4, 5, maybe even 10%, keep the difference. And because this was so easy and so profitable, it pumped global markets for decades. People don't realize how big this really was. We're talking about trillions of dollars leaving Japan and flooding into the US and global markets. And this is part of why the US stock market grew so aggressively. The bond market stayed strong. Bitcoin got massive liquidity during risk on periods, and global risk assets boomed. The carry trade was like global oxygen for the markets. But now that Japan's yields are rising, that oxygen is getting cut off, y'all. And the moment the carry trade stops working, the moment the math breaks, meaning the math ain't mathing no more, we enter into something called the reverse carry trade. And this is where things get really messy.